Now that the tax season is over, it's the perfect time to start thinking about how you can save on next year's taxes. We're halfway through the year, so you've got plenty of time to put some smart tax-saving moves into play. Reducing your biggest expense, taxes, isn't as difficult as it sounds. If you're feeling a bit lost on where to start, don't worry. We're here to help you navigate the tax-saving maze and make the process a breeze. Understanding tax planning. First, let's get clear on what tax planning actually is before diving into the strategies. Tax planning is all about analyzing your financial situation to achieve tax efficiency, meaning you pay the least amount of taxes required by law. It's completely legal and smart. Tax planning helps you make business and financial decisions that minimize your tax bill. By planning ahead, you can take advantage of tax credits and deductions that apply to your specific situation. Whether you're an employee, self-employed, or a business owner, tax planning can significantly impact your bottom line. For instance, a small business owner can reduce their taxable income by reinvesting profits into their business or taking advantage of Section 179 deductions for equipment purchases. The key is to be proactive and consult with a tax professional who can guide you through the complexities of the tax code and help you make the most of every opportunity to save. Strategy 1. Earn income. Yes, really. To start tax planning, you've got to make sure you're earning income, as there's no tax to plan for without it. The type of income you earn matters too. For instance, W-2 income from a job is taxed differently than business income from self-employment. Passive income, like dividends or rental income, is taxed at a lower rate than active income, which is earned from daily work. Understanding the nature of your income helps tailor your tax-saving strategies effectively. For example, if you earn business income, you might be able to deduct business expenses or take advantage of the Qualified Business Income (QBI) deduction, reducing your taxable income by up to 20%. If you have passive income, you might explore strategies like investing in tax-advantaged accounts to shelter some of your earnings. Strategy 2. Fund retirement accounts. Saving for retirement not only secures your future but also provides immediate tax benefits. Contributing to tax-advantaged accounts like SEP IRAs or 401k reduces your taxable income. For example, if you're self-employed, a SEP IRA lets you contribute up to 25% of your net earnings, up to a maximum of $58,000 for 2021. These contributions are tax-deductible, meaning they lower your taxable income. If you're employed, participating in your company's 401k plan can reduce your taxable income as well. For instance, if you contribute $19,500 to your 401k, your taxable income decreases by that amount. Additionally, many employers offer matching contributions, which is essentially free money towards your retirement. Besides these traditional options, Roth IRAs provide a different benefit. Contributions are made with after-tax dollars, but withdrawals during retirement are tax-free, offering significant tax savings in the long run. Strategy 3. Maximize your deductions. Maximizing deductions can significantly reduce your taxable income, which means paying less in taxes. Many small business owners miss out on deductions they're eligible for simply because they don't know about them or fail to keep proper records. For example, if you use your car for business purposes, you can deduct either the actual expenses incurred, like gas and maintenance, or use the standard mileage rate set by the IRS, which was 56 cents per mile in 2021. Similarly, if you have a dedicated home office, you can deduct a portion of your rent, utilities, and other home-related expenses. This can be done using the simplified method, a standard $5 per square foot up to 300 square feet, or by calculating the actual expenses. Education expenses like attending workshops or purchasing industry-related books are also deductible. Good bookkeeping is essential here. Using accounting software or a simple spreadsheet can help you keep track of all deductible expenses. Strategy 4. Own a business. Owning a business unlocks numerous tax-saving opportunities that aren't available to employees. For instance, as a business owner, you can deduct a wide range of business expenses such as office supplies, advertising costs, and travel expenses directly related to your business. Let's say you spend $5,000 on a new computer for your business. This expense can be deducted, reducing your taxable income. Additionally, the Qualified Business Income (QBI) deduction allows eligible business owners to deduct up to 20% of their business income, significantly lowering their tax liability. Choosing the right business structure, like an LLC or S corporation, can also affect your taxes. An LLC offers flexibility in how you're taxed, while an S corporation allows you to potentially save on self-employment taxes. For example, an S corporation can pay you a reasonable salary and distribute the remaining profits as dividends, which are not subject to self-employment taxes. Strategy 5. Health Savings Accounts. HSAs offer a triple tax advantage. Contributions are tax-deductible, the money grows tax-free, and withdrawals for qualified medical expenses are also tax-free. To qualify, you must have a high-deductible health plan. For 2022, you can contribute up to $3,650 for individual coverage or $7,300 for family coverage, with an additional $1,000 catch-up contribution if you're over 55. These contributions reduce your taxable income, providing immediate tax savings. Beyond immediate expenses, HSAs can serve as a powerful long-term investment tool. You can invest HSA funds in stocks, bonds, or mutual funds, allowing the money to grow tax-free. For example, if you invest your HSA funds and earn a return, those earnings are not taxed. Withdrawals used for qualified medical expenses are also tax-free, making HSAs an excellent way to save for future healthcare costs. Even if you don't use the funds for medical expenses after age 65, you can withdraw the money for any purpose without penalty. Strategy 6. Defer income and accelerate expenses. Putting off income and accelerating expenses can help manage your taxable income for the current year. For instance, if you're a freelancer and have a project payment due at the end of December, you might delay invoicing until January, pushing that income into the next tax year. On the flip side, you can accelerate expenses by purchasing necessary supplies or equipment before the year ends, increasing your deductions for the current year. Let's say you need a new computer for your businesses. Buying it in December rather than January allows you to claim that expense in the current tax year. This strategy is particularly useful if you anticipate being in a lower tax bracket next year. Strategy 7. Take advantage of tax credits. Tax credits directly reduce the amount of tax you owe, dollar for dollar, making them more valuable than deductions. There are numerous credits available to small business owners, such as the Research and Development (R&D) credit, which encourages businesses to invest in innovation by providing a credit for qualifying R&D expenses. For example, if your business spends $20,000 on developing a new product, you might be eligible for a credit that reduces your tax bill by that amount. Another valuable credit is the Work Opportunity Tax Credit, which offers a credit to employers who hire individuals from certain target groups facing significant barriers to employment. The credit amount varies based on the employee's category and hours worked, but can be substantial. Additionally, the Small Business Healthcare Tax Credit helps small businesses provide health insurance to their employees by covering up to 50% of their premiums paid. Strategy 8. Keep accurate records. Good record keeping is the foundation of effective tax planning. Without accurate records, you might miss out on deductions and credits you're entitled to. Plus, in the event of an audit, having detailed records can make the process much smoother and less stressful. Setting up a bookkeeping system that works for you, whether it's a spreadsheet or accounting software like QuickBooks, is crucial. Keep receipts and documentation for all business-related transactions, including office supplies, meals with clients, and travel expenses. Thorough records ensure you can maximize your deductions and minimize your tax liability. Strategy 9. Consult a tax professional. Finally, one of the best investments you can make as a small business owner is hiring a tax professional. A CPA or tax advisor can provide personalized advice tailored to your specific situation, helping you navigate complex tax laws and identify strategies you might not have considered. Tax professionals stay up to date with the latest tax laws and regulations, ensuring you're always in compliance and taking advantage of all available tax-saving opportunities. Hopefully, you now have a better understanding of tax planning and some strategies to start with.